Ever wondered if there's a secret handshake among the financially savvy? A whispered piece of wisdom that transforms your pennies into a powerful portfolio? You're not alone. We all dream of unlocking those elusive money hacks, especially when they come from the minds guiding millions of everyday investors. Today, we're diving deep into the world of Acorns, not just as a micro-investing app, but as a hub of financial wisdom. We're going to pull back the curtain and reveal the smart money tips straight from Acorns advisors themselves. Forget the get-rich-quick schemes. We're talking about actionable, sustainable strategies that can genuinely reshape your financial future. For those unfamiliar, Acorns is a fascinating player in the fintech landscape. It's built on a simple yet profound premise: make investing accessible to everyone. By rounding up your spare change from everyday purchases and investing it, Acorns has democratized the stock market, proving that you don't need a Wall Street salary to start building wealth. But beyond the clever technology, there's a human element: the financial advisors who help shape the advice and strategies offered to Acorns users. These are the experts who see the patterns, understand the pitfalls, and, most importantly, know what works. And that's precisely what we're tapping into today. Before we dive into the specific tips, let's set the stage. Why listen to Acorns advisors? Well, they're not just theoretical economists. They're on the front lines, observing the financial behaviors of a diverse user base, from students just starting out to seasoned professionals looking to optimize their savings. They see what holds people back and what propels them forward. Their advice isn't abstract, it's grounded in real-world application and designed for the everyday person navigating a complex financial landscape. So, prepare to take notes, because these aren't just tips, they're actionable insights that can genuinely transform your financial habits. The first, and arguably most crucial, smart money tip from Acorns advisors is this: automate your savings and investments. This isn't groundbreaking news in the financial world, but its importance cannot be overstated. Acorns itself is built on automation with its roundups feature. However, advisors emphasize going beyond just roundups. They strongly advocate for setting up recurring deposits into your investment accounts. Whether it's $5 a day, $50 a week, or $200 a month, the consistency is key. The psychological benefit of automation is immense. It removes the decision-making fatigue that often leads to procrastination. You're not deciding if you should save, but rather when the money will automatically move. This set-it-and-forget-it mentality is a cornerstone of long-term wealth building. It harnesses the power of compounding without requiring constant effort or willpower. Think of it this way: your future self will thank your past self for setting up this effortless financial pipeline. Building on automation, the second vital piece of advice is to start small, but start now. Many people are intimidated by investing, believing they need a substantial lump sum to begin. Acorns advisors constantly debunk this myth. Their platform thrives on micro-investing for a reason. The power of compounding interest is most effective over long periods, meaning the earlier you start, even with small amounts, the more significant the impact. Let's say you invest just $5 a day from age 25. Over 40 years, with a modest 7% average annual return, that seemingly small daily contribution could grow into a significant sum. The cost of delaying is often far greater than the perceived barrier of starting with a small amount. Don't wait for the perfect time or the perfect amount. The perfect time is always now, and the perfect amount is whatever you can consistently afford to contribute. The third smart money tip is a lesson in financial discipline: understand and minimize your fees. While Acorns has a straightforward fee structure, advisors stress the importance of being aware of all the fees associated with your investments and financial products. This includes expense ratios on ETFs and mutual funds, trading fees, advisory fees, and even ATM fees. Over time, seemingly small fees can erode a significant portion of your returns. Acorns advisors often highlight the importance of choosing low-cost index funds and ETFs for long-term growth. They advise against actively managed funds with high expense ratios, as historical data often shows that passive investing frequently outperforms active management after fees are considered. Take the time to review your statements, understand what you're paying for, and actively seek out lower-cost alternatives where appropriate. Every dollar saved on fees is another dollar working for you in your portfolio. Next up, a crucial psychological insight: focus on your long-term goals, not short-term fluctuations. The stock market is inherently volatile. There will be days, weeks, and even months when your portfolio value dips. Acorns advisors consistently emphasize the importance of maintaining a long-term perspective. They liken market downturns to sales, an opportunity to buy more assets at a lower price. Panic selling during a market correction is one of the most detrimental actions an investor can take. Instead, they advocate for a buy and hold strategy, or what's often referred to as dollar-cost averaging. By investing a fixed amount regularly, regardless of market conditions, you naturally buy more shares when prices are low and fewer when prices are high, averaging out your cost over time. This approach removes emotional decision-making from the equation and allows you to ride out market turbulence, ultimately benefiting from the long-term upward trend of the market. The fifth key piece of advice is often overlooked but incredibly powerful: diversify your investments. While Acorns automatically diversifies your portfolio through its ETF-based approach, advisors stress the underlying principle. Don't put all your eggs in one basket. Diversification means spreading your investments across different asset classes, industries, and geographies to mitigate risk. If one sector or company underperforms, the impact on your overall portfolio is lessened because other investments may be performing well. Acorns' pre-built portfolios are designed with diversification in mind, but for those with other investment accounts, the principle remains the same. Avoid concentrating too much of your wealth in a single stock or a narrow industry. A well-diversified portfolio is your shield against unexpected market shocks. With that said, thanks for watching, and until next time.